Okay, good afternoon, everyone. I'm Chye, a financial market analyst and coach at Beyond Insights. And this is your express session to get up to date with the stock market. Since we are doing this over the lunchtime, we will keep it to 20 minutes. We will cover the market highlights, major stock market indices performance, and the upcoming potential opportunities and also risks out there. So are you ready for the market update? You may type me in the chat. Okay, I see some of you responded. Yeah, me. Okay, very good. Let's go. Let me start the timer first. Just an important note before we proceed. Whatever we share here today is based on the latest data and facts. If there is a further development, things may change. And we want to make sure that you know we are not a licensed investment advisor and we do not manage customers' fund. We are an educational institution. So our purpose here is to educate people so that you can make your own decision and be your own investment manager. That way, you have a better control over your decisions, hence be able to get better results. If you are looking for stock tips, this is not the place for you. All information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. Let's start today's market update with the market highlights. So for those that are active in the stock market, how does the market looks like over the past 2 to 3 weeks? Any one of you active in the stock market, you may type in the chat, how does the market looks like over the past 2 to 3 weeks? Yeah, bearish, down. Yeah, I see quite a number of active traders or investors here. Yeah, down. So the Nasdaq 100, which track the 100 tech stocks in the United States, and also the S&P 500 that represent the overall stock market in the United States, turned into a bearish downtrend over the past 2 to 3 weeks. And the inflation has been trending down, but the inflation in the US rebounded over the past month. It rebounded from 3%, then 3.2% in July, and in August rebounded to 3.7%. And the UK, the United Kingdom, and also the European region are still at a high level despite their inflation has been trending down, which the Europe side is still at 5.2% and the UK side still at 6.7%. So for those that just now mentioned in the chat that market is bearish, anyone of you aware of what happened over the past week, over the last week? Anyone of you aware of what is the major events that caused the sell-off? You may answer in the chat. Yeah, FOMC, we have China issue. So what are the key events that moved down the stock market were? The stock market pulled back, or I would say broke the important support after a more hawkish Fed language during the September FOMC press conference, where the Fed chairman mentioned that they want to see more data. They want to see more data to confirm that the inflation is trending down and is sustainable to trending down before they relax their interest rate policy. And also at the same time, in China, there are a lot of uncertainties in China. So anyone of you aware of those uncertainties that happen in China? Anyone of you know what are the series of events that happen in China? You may answer in the chat. Okay, economic, all right. Property cost in trouble, all right. Yeah, we have property crisis in China, and we have high local government debt in China, where it may affect the banks if, let's say, the property crisis went further worsen. And we also have high unemployment in China, where they have the record high youth unemployment of 21.3% and around 5.3% of unemployment rate. And anyone know why high unemployment in China? Anyone know why the high unemployment in China? You may answer in the chat, just a quick one. All right, so why China has high unemployment? Because we have a series of factory moving out and also the slowdown in property market, where with factory moving out and also lesser construction project, people are hiring less. Hence, there are slowdown in the jobs market. And also at the same time, in China, we have low consumer demand as well. That's why they have this low inflation, negative inflation. In fact, it's called deflation. And with all these factors, the renminbi has been depreciated. And at the same time, most of the foreign funds are moving out from China, where they no longer the foreign direct investment, the FDI, which usually the foreign fund come in to set up factories, are moving out. Plus the stock market as well, foreign funds, those hedge funds, and also those foreign funds in the US are pulling out from China. And in summary, the stock market in the US currently in a downtrend. So is a downtrend good for investor? You can answer in the chat. Is a downtrend good for investor? Yes, But even we said it's good for investor, does it mean that we can buy immediately? No. So even in a downtrend, it does not mean that we can buy immediately, despite we are saying that it's a good opportunity, because for investor, you may need to patiently wait and do your own valuation first. And when the price reaches a good valuation level, you may time the entry, or you may decide the entry based on the technical chart level. So any traders here, just now I mentioned about investors. So any traders here, what traders can do? You may answer me in the chat. Any traders here and what traders can do? Okay, wait and see. I see some of the comments, wait and see. So for traders, you can short the weaker ETF. ETF means exchange traded funds. You can trade those, you can short those sectors that are affected by this high interest rate environment, those stocks that have negatively impact, or those industry have been negatively impacted by the high interest rate and the hawkish Fed, or the slowdown in China. But we do not recommend shorting stocks, because you will expose to certain risks. That's why we prefer to short weaker ETF for traders. And at the same time, traders can also trade intraday trading. So what is intraday trading? Intraday trading means that you don't keep the position overnight, where you buy and also sell in the same day, where you don't hold the position overnight. So these are the things that traders can do while the market's still in a downtrend. So you can see that investor and traders, they have a different mindset. That's why to become a successful investor or traders, you may need to have a variety of trading styles and be more versatile. So after the market highlights, let's move on to the overall market performance as of 22nd September 2023. Despite the US stock market has been coming down, you can see that the overall long term is still going up. But however, things may drop further if, let's say, there are further development or there are further negative news. Especially recently, we can see a series of negative news that move down the market. And over the 10 years, Nasdaq 100 has been the top performer. You can see that average per year return of 44.2%. S&P 500, that represent the overall stock market in the US, has been an average per year of 19.3%. And the China region will give you around 3.96% average. Hang Seng Index minus 2.23%, and Malaysian market has been slow over the past years and has at average return of minus 1.38%. From here, you can see that when the US stock market coming down, you can see that other markets follow as well. It has been coming down as well. However, this does not mean that you can buy immediately, like I mentioned earlier. Investor can have their patience to continue to wait and only buy at the right valuation, while traders can trade short term using intraday techniques or short the weaker ETF in the market. Also, as an investor, we want the most consistent market or asset when we invest. We may gauge how we do that. We can, in a simple way, we can gauge how is their past performance. So these are the past performance I shared just now. From here, which market performed the best over the past 10 years? You may answer me in the chat. Yeah, US still provide the best return. Does anyone know why? Know why that the US providing the best return over the past 10 years? You may answer me in the chat section. Volume, all right, many good companies. Yes, because they have more well-run and also profitable companies, and it is more regulated as well. And anyone of you know what company that is well-run in the US? You may type in the chat which company that you know of are well-run in the United States stock market. Yeah, Apple, Microsoft, Google, and so on. So despite we are currently in a downtrend, I would say that the current downtrend might be temporary and short-term. Funds may come back in once the valuation is at attractive level, and when we have the rate pause or the first rate cut by the Fed itself, which likely to be, I would say, likely would be only, it's not a confirmed thing, likely would be around second half of 2024 when the Fed has their first rate cut, or when they start to pause their interest rate and start to tone down in a more dovish language. So this will be an opportunity for you at that point. From now until year end, I would say it's still uncertain from the Fed. You can see that the still hawkish language throughout the FOMC meeting. So I would say second half of next year potentially could be a very good opportunity, or let's say you can see the Fed start to move to a more dovish language. And also just now we mentioned about China uncertainty or China crisis. So if let's say funds were moving out from China, which market the money likely will go? If let's say China slowing down, foreign funds or those hedge funds are moving out from China, which country or which market they're likely to go? Yes, either the US market and also the Asian market. Okay, so other than the stock charts and also certain facts I mentioned just now, there are still money on the sidelines. So why I said money on the sidelines? Based on our research, there are a record of $5.3 trillion in cash on the sidelines. From the chart here, you can see that the money market fund, which is a place where investors or those big funds temporarily park their cash when they withdraw from all these risk assets, such as the stock market or bonds market. They usually will park in the money market funds to earn short-term interest. And there are 5.3 trillion in cash on the sidelines. And part of the reason why investors are stocking up on cash is to take advantage of the current high risk-free rate due to high interest rate. So does anyone of you aware of what is the interest rate now in the United States? Yeah, 5.5%. So if let's say you are a big funds, currently if let's say stock market shown some uncertainty, if let's say you move into a fixed income asset, for example, like the money market fund, you are earning 5.5% interest rate, which is quite a good return and it's a risk-free return. That's why currently most of the funds still staying in the sideline. This is where you can see from the money market fund situation. And this massive 5.3 trillion pile of cash could act as a fuel to drive the next bull market when they are moving out from the defensive asset or the cash position into risk asset again, when they are on the risk on mode where they want to go into the risk asset. So what are the risk asset will be either the stock, or they may move into the bonds, which are more conservative, another fixed income asset. But now this 5.3 trillion still in the sideline, which may fuel the next bull market. And having covered all the facts just now about the stock market, what are the latest development, what is the reason the stock market dropped and so on. What's important for the investor and traders, and I believe those of you that join this market update will be want to know what to focus on second half of 2023. And let's see the opportunities first. However, during a downtrend, what's important here is we must take care of our risk first. So later on, I will cover the risk, but the priority is supposed to be, if let's say you are investor that currently still in position, you should take care of the risk first. But for those that already in the sideline or just wanted to come into the stock market, let's take a look on what are the potential opportunities for you to come into the stock market, especially second half of 2023 or first half of 2024. So for industries, for those opportunities will be lies in industry aligned with key themes. For example, like mega trends. So mega trends refers to those trends that in line with the industry evolution. For example, recently we have artificial intelligence, or those industry that are in like big data, next generation broadband, or even clean energy and so on. So does anyone know the companies that are in line with these mega trends? Any one of you knows that these are the companies that in line with all these mega trends like AI, like 5G or 6G or cashless payment or clean energy? Yes, Nvidia, Microsoft, all these are in line with the industry mega trend. And also we have this PC and smartphone demand recovery in 2024. This one, initially we project that the PC and smartphone market may recover second half or late 2023. However, with the current slowdown in China and all this slowdown in consumer spending, it could be possibly defer or further delayed to 2024 or second half of 2024. However, these themes are still valid because usually how long does you change your laptop or smartphones? Usually what is the cycle, the duration that you change your smartphone or laptops? Yes, 5 years. And we can see that there is a spike of upgrades during the pandemic 2020. So 3 to 5 years is the usual upgrade cycle, where we can see that we are almost due. We are almost at that cycle. People may defer to upgrade their laptops or smartphone in, let's say, 3 years, but usually the 5-year cycle is coming soon. So I would say these themes are still valid. It's just deferred to 2024 or late 2024. And also we can focus companies with low debt, low exposure to bonds, and also strong cash flow. So companies that in a strong cash position, we can focus on those with strong balance sheet, low debt or no debts, and having a very strong cash flow, and avoid those that has high exposure to the bond, especially those in the financial market, where they may holding bonds that are having a very huge unrealized losses. So we need to avoid those companies, especially in those in the financial sectors where they exposed to bonds and also a lot of loan out where high interest rate environment may affect them, may negatively affect them. And also we can focus on companies with less vulnerable to tightening of consumer spending. So any one of you known any company that are less vulnerable to tightening of consumer spending, you may answer in the chat. All right, Costco, Pepsi, yes, this one, okay. There are a few types of company with less vulnerable to tightening of consumer spending. You can focus on those companies that are in line with the mega trends, especially those recent AI themes, where the corporate need to upgrade their system in order to stay competitive. Where nowadays their revenue has been transitioned to more towards corporate spending rather than consumer spending. For example, Microsoft and Nvidia, those type of company where recently due to the AI trend, all the corporate need to upgrade. So especially Microsoft, like for example, Microsoft, Nvidia, all these are in line with the AI themes. And also to mention about Costco and also like those Walmart and so on, I would say companies with low foreign revenue exposure due to the strong dollars. So there are two questions here. Number one, why I said Costco suitable for low foreign revenue exposure, these themes. Anyone would like to answer me in the chat? So why Costco belongs to this group of companies? Yeah, because Costco majority of their revenue is coming from the United States. They are selling to the US market, and with strong dollars, they may have their export cost lowered due to the strong dollars, and they are continue to selling to the US citizens or US consumers. So these are the company that if let's say you continue to see the strong dollars due to the hawkish Fed, due to the interest rate high differential between Europe region and US, because the US still insists they want to hike another 1 or 2 times, then this kind of company may benefits from the prolonged strong dollars. Because why prolonged strong dollars? Because China also in a bad situation in terms of their economy. So it will favor the US. And also, like I mentioned earlier, money on the sidelines, 5.3 trillion cash on the sidelines, potentially may come into stock market. Once the rate high cycle is over, this fund may go to either stock market or go to the bonds market to lock in the longer term bond yield. And what are the risks that are currently we are looking at? Because as an investor, we may look on the opportunities and we may need to evaluate the potential risk as well. So if let's say high interest rate prolong, you can see that it may impact the affordability because loans are more expensive now with high interest rate. And we also have the bond market risk where those companies that invest heavily in the bond market earlier on during the downturn or when the rate hike is very fast, they may suffering a lot of unrealized losses. And this may affect their revenue or may affect their balance sheet if let's say Fed continue to be hawkish for a while. And also the housing market with the mortgage rate at almost like, I think over 8%, almost around that region in the US, this may affect the housing market, especially those companies that are selling houses. And like I mentioned earlier, prolonged strong USD due to the interest rate differential, a more hawkish central bank in the US, and also the slowdown in China. This will cause prolonged strong US dollars. And also geopolitical tension between US, China, and also we still have the Ukraine-Russia war. This may cause the this issue may not go away. So there are still uncertainties. And plus with all these trade restrictions, trade regulations between China and US, this is a potential risk. And also slowing down in consumer spending where we have the China economic crisis. So if let's say China continue to be uncertain, it may be bad for those China companies that are listed in the US and yet they are heavily exposed their revenue in China, where their revenue collected in China might become lower when it convert to US dollars. So this, you may need to avoid all these China companies listed in the US that expose heavily in China region. And also higher risk on the discretionary side, especially those with higher dependency on China. For example, any one of you know which company that in the US that are depend on China heavily? So you may type in the chat. So let me proceed because we are running out of time. It has been countdown to 0. And also the finance sector, like I mentioned earlier, due to the high exposure to bonds, and also with high interest rate, there are more risks that people may default their loans if let's say the mortgage rates continue to go up. And energy sectors may cause some uncertainty if let's say we have more other news, but Now, energy sectors, I would say, currently still bullish due to the production cut by Saudi and also Russia. And try avoid the retail industries for now as well because consumer spending are slowing down. That's why I would say it would focus on those companies that has themes that in line with mega trend that corporate need to spend to upgrade their system. So this will be a more safer companies, for example, like Microsoft and also like Nvidia. So from here, we also know that in the press conference during FOMC, they mentioned that the Fed chairman still mentioned that US still have the strong economy. And from all the facts I shared just now, we have a strong dollar. And the US still has the most strong fundamental company, for example, Nvidia, Microsoft, and also Meta. These three are aligned with AI. And let's say if you are a fund manager, or an seasoned investor, where the money will move to? You may answer me in the chat. Where likely the money will move to? If let's say you are a fund manager, yeah, AI or the tech stocks in the US market, because you have strong dollars, you have strong economy, and also you have companies that are leading in this AI mega trends. So you can take this downturn, this stock downturn, to learn and also capitalize to get in these great stocks, and don't buy. And remember, like I shared earlier, don't buy on the way down. We may need to do our own valuation and also confirm with the stock charts itself. And I would say the stock market is still the best instrument to generate higher returns than inflation. And the US stock market still has the most consistent return. They have more high quality companies to invest in. However, having said that, we want to do it in a safe and systematic way. A downtrend does not mean we can buy immediately because things may go down further. So Beyond Insight, we have the most systematic course in the market where we cover the process step for every single trading style. We have the most versatile strategies, like I mentioned earlier. You see that we have a series of courses covering from investing to even intraday trading. And also we have a safe approach where we manage the risk properly. And you need to plan in some time for you to practice and also pick up the skill set while waiting for the opportunities, because just now I mentioned, potentially earlier next year or second half of next year, you may have the opportunities when the Fed has more certain policies and when they have the first rate cut. So these are the potential opportunity where the market may go up, and these are the few that potentially move the market up. And since this is just a 20 minutes update, and I know that I'm well run out of time, overrun the time, we would like to invite you to a free 3 hours webinar that covers a framework on how to approach the stock market in a systematic, versatile, and also safe way. Also, we have a hybrid class for the upcoming intake, face-to-face, and hybrid class means we have face-to-face and also online happen at the same time. So do join the 3-hour webinar to find out more. And the next available webinar will be on the 27th September, this Wednesday, 7:30 p.m. You may scan the QR code to register. And now I will open the floor for some Q&A. Maybe I can take 2 to 3 questions. I will answer that. So any one of you fast enough to type your question in the chat section now, I would answer your question. So I see Yung Sing sent out a few pick up some of the question you all typed in the chat earlier on. So what are the weaker ETF? So with the current downturn, I would say those ETF that are impacted by the high interest rate environment, for example, those regional banks ETF, or those emerging stocks ETF, for example, or let's say you know how to time the chart, you can take a look on all these technology sectors that are affected by this recent hawkish Fed. For example, those that are affected by the China-US tech war as well, like for example, the semicon sector. But I would say those semicon sectors still have the feel from AI, so do trade carefully, but you can short on those weaker ETF, like for example, I mentioned earlier, the regional bank and so on. And question from Azran, if more traders went for intraday, how does it impact the market performance? So if let's say more traders went for intradays, we may have more volume. And you may have some volatility, but usually when the big funds are selling, these are the big volatility. And what intraday traders can do is just follow the direction. If let's say big funds are selling, you're just shorting those ETF or stocks that are selling off by the big funds. So intraday is like a skill set where you need to time more using the charts. And I would say if let's say more and more people going intraday, it will be creating more and more volume, because intraday traders usually buy in more stocks, more units of stocks, and also buy and sell in the same day. So it can create more volumes and create more liquidity to the stock market. And lastly will be how long this market will last. So as an investor or seasoned investor or traders, we may not know the future. Everything is about probability. So I would say for now, based on the chart, it could potentially go down further. And you may need to wait for the turning point. And on the macro factor side, currently Fed are still very hawkish in terms of their press conference language. So I would say once the policy has more certainty, plus you time with the technical chart, when you see the recovery, then this is the time to turn around and you may start to gradually going into your investment position or your trading position. And lastly, I think I can answer maybe two more because I see not much question left. So how we can know movement of money on the sideline? Okay, this is very good questions. You may monitor the money market funds from time to time. If let's say you see some news or when you can see there are huge volume going into the stock market when the stock market strongly recovered, that will be potentially people call the asset rotation, where funds are pouring into the stock market. You can join our webinar to find out more or sign up some of the courses to understand more. And lastly would be for those already in the market, should we get out and wait for trend reversal? So investor and traders have their own process. So investor, yes, if let's say you are still in a position, the technical level still holding, it's still according to your investment plan, then you can still stay in the market. And for the traders, with the current correction, it should have already hit your stop loss and already get you out, and you may wait for the trend reversal. All right, so yeah, if we are getting more and more questions, so let me just answer the last one, which is very interesting about Apple. Apple restricted by China and limit more tech company and selling in China. Would Apple still be a good stock? I would say temporary monitor Apple first, not to get in too soon, and monitor the key support level for Apple, because with the Huawei chips and China start to limit the usage of iPhone. They are not totally banning iPhone in China. They are only limit their government servant to use iPhone. So may need to monitor further. I would say for now, the safer stock will be those less exposure to China one, and still in line with the AI megatrend, because corporate need to spend their capital or money into upgrade their system to have AI system and so on. So I would say focus on those less exposure to China one first. All right, so with that, I think that's coming towards the end of the session. And see you all again during the next market update next month. And remember to scan the QR code or introduce this link to your friend. If let's say you find this market update is useful and you want to get your friend to join the upcoming webinar by Kathleen. All right, so see you all and bye-bye and trade well and invest well.